The president has today been expected, I think he might be doing it now, signing executive orders. I think he just signed it moments ago. This wasn't open to the press, but he has an event next hour that we will cover. But he's signing executive orders today, and they're financially related. And one of them is really interesting. I want to talk about it for a few minutes. It could be about, or could change the way, I guess, that you might save for retirement. The proposed change the president is talking about is allowing alternative assets, okay? So things like private equity or real estate, crypto even, to be in your 401k. So that would be a big win for like asset managers because it would give them access to a huge market. It's worth an estimated $12 trillion. But what would it mean for the rest of us? Doug Flynn is here, co-founder at Flynn Zito Capital Management. Now we're basically limited, right, Doug, when you advise people to think, you know, stocks and bonds, what we call traditional investments. But if we can do this, is it a good thing? Does it come with risks? How do you see it?
It's good. We can do it on the private side when people have their own money or they roll their money out of the 401ks. You certainly have access to the private markets. But inside the 401k, because they're really mass sort of applied, they have not allowed people to do that. Now, endowments, foundations all have access to this, and pension plans have access to this. But so what happens is there's positives and negatives like anything else. And some of the positives are that the returns have been higher than traditional stocks and other investments, but that comes with illiquidity, it comes with higher fees. And so the big problem is that when people change jobs, about a little more than 40% of those people, when they do, they actually take money out of their 401k. And over 85% of those people that take money take all of it. And so a lot of these assets are illiquid, and that's going to cause people, if they're using illiquid investments, which you would need to do to get these higher returns, they may not have access to all their money. Now, you're not supposed to be touching that money because it was set aside for retirement, but sometimes people's circumstances are such that they need that. So look, I think in a small percentage, or if they're doing it inside of something that is more liquid, you know, all this needs to be worked out. There are some benefits, but it comes with some caveats, and we just have to see how they actually implement it.
No, those are really good points. I know you do this for a living, so I hadn't even thought of some of that, and those are really good points. What I did think of initially was that, you know, this is in some ways, like, I see it as an access issue, you know, because normal people, just anybody has a job, you have certain things you could invest in. Oh, you got to pick this stock fund or this bond fund. Right. But then the so-called fat cats, or you know, that's what people say anyway, that, well, they can do all this stuff and they're making bigger returns. But now at least everybody would get more access.
Yeah, it's a good point, because like if you look at 30 years ago, there was 8,000 publicly traded companies, and now that's down to 4,000. Now on the private side, it's anywhere from 10 to 20,000 private companies. It's gone up fivefold depending on which measures you look at. And so, you know, more companies are deciding to stay private. They have access. It's too regulated on the public side. You know, mergers and delistings happen, so there's less and less to invest in the public markets. So people are getting squeezed out from all these other opportunities. So I think a lot of that is where that comes from, is giving them the access like everyone else has to those other companies, some of which are large and you might even know them. They're just not publicly traded. So let's get some access to the people there.
No, and you're right to point out what some of the risks are as well. Doug, as always, thank you. Doug Flynn there. We'll get a break.